Hi, I'm Tom Bradley, President of Steadyhand Investment Funds. Today I've got with me Brian Eby. Brian is a Vice President and Director at Connor Clark & Lunn Investment Management, and him and his team manage the Income Fund. And so today we're here to talk about specifically the Income Fund, recent performance, and some of the strategies that they're bringing to bear as we think about the interesting environment we have. Brian, welcome.
Thanks, Tom.
You ready to get at it?
Absolutely.
Okay. Well, I'm going to throw you a lob ball to start, and really because 2014 was another excellent year for the fund, and you've Connor Clark & Lunn certainly delivered for our clients over time, but maybe you can just give me a feel for what's been driving the returns, and not only 2014, but in previous years.
We've really been beneficiaries of an ongoing trend we've seen over the last number of years, which has really been a big demand for stable income-oriented investments. But in addition to that, we have been able to add value from our allocation to income-oriented stocks and corporate bonds, including high-yield bonds, as well as the security-specific decisions we've made in each of those areas.
Now, you talked about having effectively a tailwind over the last number of years. As we look forward, maybe to just set expectations for our clients, do you think it's realistic that we can achieve those returns going forward?
No, unfortunately, and really across most asset classes, our view is that returns are going to be notably lower over the next 5 years than what we had over the last 5 years. In this fund, currently the yield on the fund is around 3%. Our return expectation would be probably in the range of 3 to 4% over the next 5 years. So that gives you a rough sense. But to put that into perspective, a 10-year Government of Canada bond yields around 1.5% right now. And is more vulnerable to an increase in interest rates than this fund would be.
Well, you've hit right on the question on most people's minds, I think, interest rates. You've touched on it, but maybe you could give us your view and your team's view on interest rates, and then how you've positioned the fund relative to that view.
Yeah, so the question we often get most years is how much are interest rates about to increase? I've had that question most of the past 5 years, and every year they seem to go lower. At the moment, it's hard for us to see an environment which might cause interest rates to increase yet because of the quite frankly, massive deflationary forces we're seeing around the globe, really falling price levels. Now, having said that, if we were to see an increase in interest rates, the fund is likely to do better than a traditional bond fund. And the reason for that is the average term of the bonds that we have in the portfolio, as well as some of the income-oriented stocks in particular that won't be quite as vulnerable.
Okay. Well, that's one of the big components in the fund is corporate bonds. So maybe you could just update us on where your focus is there now and what you're looking for.
Yeah. In the corporate market, there's a bit of a trend happening, which is a bit of a concern for us, and that is that companies are increasingly using their balance sheets more aggressively. The starting point being their balance sheets are in great shape right now, but they're starting to use them for the benefit of equity holders and at the expense of bond holders. And so an example would be Enbridge, who recently moved a portion of their assets away from their holding company down into a limited partnership. And that caused the bond price to drop 5 or 6%. And if we look back, for instance, the Tim Hortons Burger King deal in the summer, that resulted in Tim Hortons bonds dropping 7 or 8%. And so these kinds of things are a bit of a concern to us. And so we're taking a more cautious stance in that segment of the market. And we're also applying a bit of a quality bias. So the most of our corporate holdings are single A rated or higher. About 8% of the portfolio only is triple B rated, and we don't own any high yield bonds at the moment, which would be bonds rated below triple B.
Well, Brian, even though we don't own high yield right now, I think it'd be useful to do a bit of a primer on those kind of bonds, because it will in the future be a part of the fund, and it's been a good contributor to returns to date. So what are the basics, and what would lead you to buy them again?
So, Tom, in the bond market, we typically segment corporate bonds into investment grade and high yield, and the differentiation being credit rating. So above triple B is considered investment grade, below triple B high yield. The high yield market also typically offers a better return expectation, and so there's often great opportunities in it. But at the moment, we're taking a cautious stance, and in the Canadian high yield market, about 30% of it is energy names. And they've been coming under a lot of pressure because of the lower oil prices. And at the moment, at least, our concern is that there is probably more downside risk, and that it runs the risk of stressing the broader high yield market at the moment. So we're going to take a cautious stance and wait for a better opportunity.
Now, that caution, in a way, you're reallocating some of your risk budget to the provincial sector. The fund owns almost no Government of Canada bonds, and owns lots of Ontarios and Quebecs. Some of our clients tell us are both basket cases as far as fiscal responsibility goes. What's the rationale there?
So you're right, Tom. I'd like to see them a little more disciplined on the fiscal side. But they do have unfettered taxing ability, and we are getting 75 to 100 basis points more than investing in a Government of Canada bond. And at least in this environment, we are more optimistic because at least Ontario and Quebec in particular, are big beneficiaries of lower energy prices, a strengthening U.S. economy, and a weakening Canadian dollar, all admittedly interrelated.
Brian, before we wrap up, I want to talk about stocks. They're about 30% of the portfolio, been an important driver of returns really since 2009. Maybe you can give us a bit of a sense of what you're looking for there and what you're focused on.
So within that segment, what we're really looking for primarily is long-term, stable, relatively predictable cash flows while preserving capital values. But that doesn't necessarily mean just dividend-paying stocks. We're looking at a balance of decent dividends, but also dividend growers, which we think will perform better in the future. We do have a bias to those businesses that will benefit from a strengthening U.S. economy, which is one of the things that we see happening over the next 6 months. And in addition to that, we've been adding a little bit to the REIT sector, in particular more diversified names, and the utility sector. Within utilities, our emphasis is really on the more regulated-like names, and we're avoiding the names that are possibly a little more sensitive to what's happening in the energy sector.
Brian, thanks for doing this. It's been a great update on the income fund, and we'll look forward to doing it again. Thank you.
Great.